I will record. Yes, it's starting. So, as said, this is the first version of this webinar series, and I'd like to, well, first thank Katja for being the guinea pig in this, but also everyone for joining. And because this is the first version, let me, well, basically lay down some ground rules for this webinar. And I'd also like to ask you for feedback after the webinar. So if you have feedback, just please send me an email how we can improve this series. So the first ground rule is basically please mute your audio so that we don't hear my neighbor's dog, for example, barking, or just the construction that's going on. If you have a question, so we want to be still as interactive as possible. So if you have a question, please just write your name in the chat. That is one of this message bubble right next to the 3 dots in the control bar. Just write your name or just say question so that I can see that you have a question, and then I will make sure that this is answered. And we also try to have breaks, just Q&A breaks in between the presentation. If it's an urgent question, so just really a clarification question without the answer, you wouldn't understand anything anymore, please don't hesitate to just give me a shout or just unmute your audio and say, Katja, sorry, I really don't understand that. But for any other more discussion-like questions, please write your name down and we'll still, as said, make Q&A breaks in between and also, of course, after Katja's presentation. And don't forget for that to unmute your audio if you want to ask the question, but otherwise have it all on mute. That being said, let me introduce Katja first. So Katja is now a senior lecturer at the School of Risk and Actuarial Studies at UNSW. She's also an associate investigator at CEPAR and has been a senior research fellow actually before joining the school. And at CEPAR, she's developing the research program for the Australia-China Population Aging Research Hub. Her research is mainly on risk management, but also insurance economics with a focus on China. And her presentation, as she already shared her slides, today we'll hear about the long-term care financing using home equity release. So Katja, the online floor is all yours.
Yes, thank you so much, Inka, for testing and setting this all up. And hi, everyone, and welcome to my living room. So I'm at my dinner table, so feel free to grab your lunch and just a cup of coffee, and we'll keep this. I'll try to present. Hi, David. So I will present for about...
Is now exiting.
I will present for about 30 minutes, and I'm very happy to take your questions in between, and there will be plenty of time for Q&A at the end. So Inka has given all the necessary instructions, so I'll just start. So this is a joint project with Hazel Bateman, Han-Ming Fang, who is a CEPAR partner investigator based in Philadelphia at the University of Pennsylvania, and Tin Long Ho, who is one of our PhD students in CEPAR and in the school. And the motivation for our project is that there is very rapid population aging in China. So China has achieved large increases in life expectancy, large improvements in health, and as a result, people are living longer and longer, and there's more and more a growing older population, and they will need long-term care services. And there's an increased demand for both informal and for formal long-term care. And our colleagues in CEPAR, particularly Liu Bei and John Pigott and their collaborators in China, have done terrific work on estimating the need for formal and informal care and long-term care in China. And the challenges that China is facing is the change in the demographic structure, the fact that there's more and more older people and less younger family members to look after this larger older population. But then there's also changes in the labor force participation and the mobility of family members. So often family members now move away to work in other cities. It's then harder for them to look after their elderly parents. And also we saw an increase in female labor force participation in China. And as a result, there is less, there are fewer informal caretakers available, and there's just a larger need for both informal and formal long-term care. The Chinese government is undertaking several reforms around health and aged care in China. So they announced in 2016 the Healthy China 2030 strategy, where they outlined several targets for the health and aged care sector. And these targets are aligned with the United Nations Sustainable Development Goals. The area that is relevant for our study is that the Chinese government is trying to implement a system of public long-term care support, and they are also interested in fostering the development of a private market for health insurance product, and also they're looking at long-term care insurance. So there are several ongoing long-term care insurance programs, and again, our colleague Lu Bei, she has done very substantial work on analyzing one of the programs that it's run in Qingdao. So we know a lot about these reforms and these initiatives. But the question is how to fund all this. So long-term care has a high incidence, high cost, and it poses a challenge for financing. So a potential source for financing aged care is housing wealth, because as in many other countries, housing wealth is a large component of household wealth in China. So different studies, and I'm citing just one here by Xi and Jin, find that housing wealth is a very large component of household wealth in China. And this has to do with very rapid house price increases and limited development financial markets, limited other investment opportunities. So a lot of wealth is held in the form of housing, residential housing in China. And so the idea now is how to use this wealth to convert it and to pay for care, for aged care. So the Chinese government has recognized that reverse mortgages can be a potential solution to unlock this wealth, this equity stored in people's homes. And they have authorized one insurance company, Happy Life Insurance Company, to sell reverse mortgages. And this company started to sell reverse mortgages in 2014. And they have offered a product since then, which is very unpopular. So we have in a separate paper, which is shown on this slide, just at the bottom, we've just published a paper where we very carefully analyzed this product and this pilot program in China. We try to understand why it is so unpopular, and we designed a new product that takes into account criticism and shortcomings of the existing product and factors that we know affect reverse mortgage demand from the literature. There's extensive research on reverse mortgage demand now, and we've developed a more flexible product and a product presentation format that is easy to understand. And we find that if you offer people, like if you offer a representative sample of consumers this new product and you make sure they really understand that product, there is substantial demand for this product. And we tested two samples. One sample was potential clients themselves, like older homeowners living in urban areas in China. And we found that these homeowners aged 45 to 69 were interested in a reverse mortgage. And we also looked at a younger sample of children of older homeowners and found that they would recommend reverse mortgages to their parents, which was quite surprising and I guess a bit different from what people would have expected. So what's interesting for our research project today is that when we asked individuals how they wanted to use the reverse mortgage payments, they gave two main reasons and two main uses, and one was to live more comfortably, but the second was to pay for better medical treatment and aged care services. And this links in with our study that I'm talking about today. So in this project, we assess the demand for a product combination for a bundle of a long-term care insurance and home equity release products. And it is an experimental survey that we fielded in China. And we looked at three research questions. The first was, do individuals buy more long-term care insurance when they can release their housing wealth? Second question, what is the preferred product combination? Would they like to borrow against their home using a reverse mortgage to pay for long-term care insurance? Or would they like to sell part of the home using a home reversion to pay for long-term care insurance. So we're comparing two different forms of equity release, and we looked at different characteristics of the individuals to see how these characteristics impact their stated product demand. So this is what the motivation and what we're planning to do. So I'm making a quick stop here to see if there are any questions on the first 3 slides so far. Check the chat. No?
So far, no one in the chat.
Okay, very good. Then I take this as all clear and I'll continue. So our study
Katja, can you share your slides again? I think.
Oh, sure. Sorry about that. Okay. So this is where I just finished off. So these are our 3 research questions, and we are contributing to a literature, to different strands of the literature. So there's a growing literature looking at the optimal allocation of housing wealth and the optimal demand for retirement financial products over the life cycle. And I'm listing here a few papers that have specifically looked at housing wealth, reverse mortgages, and long-term care insurance. So a very early paper by Davidov showed that when housing wealth cannot be released, just locked up, then having a house and long-term care insurance are substitutes. So people might not buy long-term care insurance and instead just hold on to the house, and when they become disabled, sell the house and pay for care. But if you introduce reverse mortgages, these two become complements. So then people can use reverse mortgages to buy more long-term care insurance and have a demand for these both products. And we, in a paper in the Journal of Risk and Insurance in 2016, with Mike Sherris and Thomas Post, we looked at this a bit more in detail for home reversion and reverse mortgages in a life cycle model, and we find a similar result. We found reverse mortgages are theoretically more preferred. And then Mike Sherris, Adam Shao, and Hua Chen, they have a new paper in the Insurance Mathematics and Economics, where they also looked at a life cycle model and the interaction between housing and long-term care insurance. And very recently also our CEPAR partner investigator Hans Fehr has a paper on a similar topic. So these are life cycle models. Then there are a few papers that specifically discuss the combination of long-term care insurance and reverse mortgages into one product. And so there was some very early studies, Benegem and Alstrom, and they discuss the design of such a product. And there's recently there have been recently a few actuarial papers that look at the pricing of these combined products. Zhao, Andrews, and Hobroy is in Annals of Actuarial Science. Mayu is in Geneva papers. So basically this idea has been in the literature to combine these products, but nobody has looked at the potential demand for this. So the idea has been proposed. People have shown how to price these products, but is it actually something that people want? So there's also a growing literature on long-term care insurance demand being assessed in experimental surveys. So Hazel and Susan and Xiang and Corsus, they have a paper and a working paper on a combination of annuities and long-term care insurance. And I think you've probably seen this being presented in different CEPAR events. Then there's a recent study on by Akaichi and Jean Costa Fondegral and some courses on a discrete choice experiment for different features of long-term care insurance. And then Martin Boyer, he has a study in Canada where they look at, again, different product characteristics of long-term care insurance. There's a growing literature looking at the demand for long-term care insurance, but they haven't looked at combining it with reverse mortgages, which is what we're doing here. So we're contributing, kind of trying to link these literatures, but using experimental survey methods. Okay, so talking more about the methodology. So what we do is we fielded a survey in China, which tests the demand for 3 hypothetical products, which currently don't exist in the market. We also collect a lot of information about the individuals who answered these surveys in and this information we're using as covariates in our regression analysis. We develop our survey design very, very carefully. So we started out with an initial design, which we developed based on a very detailed reading of the literature and media reports and discussing with experts and family and friends. And we tested it with focus groups in Shanghai. So we invited 2 groups of 6 Chinese people and with a moderator walked them through our first version of our questionnaire in Chinese and videotaped their responses and their questions. And this helped us to improve our survey design because these people told us what's unclear and what they couldn't understand and where the translation was a bit funny. And then we programmed this in English and in Chinese, and we did extensive testing of the survey. So a lot of our friends and family have been involved in testing this, and I'm thanking everyone who's here today who answered this survey for us. When we were satisfied with the design, we asked a commercial panel provider called DataSpring to send out email invitations to a commercial web panel, to individuals who have signed up with this company to regularly participate in surveys and getting paid for it. And in our case, the participants received a fixed participation fee plus a bonus payment, which depended on a quiz about the products that we introduced. So we tried to incentivize attention in the survey and understanding by letting individuals know that if they do well in a quiz, they can earn a bit more for taking a survey. The sample is 1,200 people living in urban areas in China. And we implemented some quotas to get a representative age split, a good spread across different sizes of cities, tier 1, tier 2 cities. We required people to have registration, hukou registration in the city where they live, so they have a bit of a longer link to that city. We only included homeowners because we're looking at home equity release. Same split of male and female. We set education quotas and we excluded anyone who had a disability in terms of a limitation of activities of daily living because they wouldn't classify for long-term care insurance. This is a summary of our method. Are there any questions? Okay. The survey started then with a short introduction where we had some screening questions to make sure that people satisfy the quotas I just described. We allocated individuals into different groups of wealth and what kind of city they live in, so that the task that they later performed had numbers that are similar to their own financial situation. So it wasn't individually customized, but it was customized, the task and the experiment was customized into 8 groups that broadly matched the individual's financial situation. We also matched the individual's gender and whether they were married or single. So they saw exactly in the setting, they saw exactly their own demographics, basically. We then showed individuals a slide which is called Facts About Health States and Long-Term Care, a simplified description of long-term care risks. We told them about this hypothetical situation that they were making decisions in, and then they had to do choice tasks. And in each task, we started by introducing a financial product, describing the product, giving them a numerical example, and then asking them to indicate their demand for this product using a slider. And because we were worried that the order in which we introduced the products could impact demand, we randomized the product order. So some people saw one product first and then the other, and for some people it was the opposite. We were also concerned that the numbers we listed in the numerical example would set a reference point and people would think, oh, these are good numbers, I should make an allocation similar to the example. So we randomized the numbers that people saw in the examples. Some people saw an example with a bit lower numbers and some with some higher numbers. And so people chose long-term care insurance in 3 different scenarios, and they completed a quiz, and then they answered a lot of background questions about their personal characteristics, their personal situation, and some outlook and expectations. So I'll talk about that a bit later. So this is the structure of our questionnaire. So this slide is important. So if you've been browsing your emails, stop that now and look at the slide because it will really help you follow the rest of the presentation. So, so in this experiment, we have 3 products. We have a long-term care insurance, which we call LTCI, and to the individual, we called it long-term care income product. We didn't use the name insurance because we were worried that some people would have a negative perception of insurance. So this long-term care income product is a product that starts to make makes monthly income payments when the individual or their spouse become disabled. That means they have problems performing 3 or more activities of daily living. So it is an insurance that is triggered by disability. It is for, if the individual is married, it's for a couple, it's joint for both spouses. And if one of them gets disabled, they get 1 payment. And if both get disabled, they get basically the double amount. And so this is the basic product. And this is offered, LTCI is offered in one of the scenarios. Sorry, this is offered in all of the scenarios. So when you look at the first, say, the columns, the first column gives you the products, and then the 3rd, 2nd, and 4th column give you the scenarios. So there's a scenario where there's only long-term care insurance available, and then in the other 2 scenarios, there is this basic long-term care insurance and the other products as well, because we want to give individuals the choice to either use their savings or to tap into their home equity. So the first product is paid from savings. The 2nd and the 3rd product are very similar in the payout structure. So they make the same monthly payments and they have the same trigger for the insurance to be paid out, but the premium is paid in a different way. In all 3 products, it's a single premium. And the first product is paid from savings, as I said before. In the 2nd product, the individual borrows against the home using a reverse mortgage and pays the premium. So at the beginning of the contract, when the individual decides to buy this product, they borrow, take out a loan, all the amount goes to the provider, and the individual has a debt which accumulates and is only repaid when the individual passes away, or there's if it's a couple, if the last survivor of the family couple passes away, then the house is sold and the sale proceeds are used to repay the loan plus the accumulated interest. And so there's no interest payments while the individual is alive. It's all been settled at the end. So they just take out a loan, they have a loan, and that accumulates compound interest, but they don't have to make repayments while they are alive and still live in the home. And they have a guaranteed right to stay living in the home. The 3rd product is a partial sale of the home. So this is a financial product that's called home reversion, which exists in the UK. So it's, instead of taking out a loan, the individual sells a fraction of the equity to the provider and gets a payout, which in this case is not paid out to the individual, it's just used to buy long-term care insurance. So as I said before, there is the first product, which is paid from savings, is available in all 3 scenarios, but then there is a scenario, for example, the 2nd scenario in this table is where they can choose to buy long-term care insurance either from using product LTCI, just their savings, or product LTCIR to borrow. Or the 3rd scenario is they can use the savings or sell part of the house. So this is what the structure is of the products and scenarios. So it's very important to make individuals aware of long-term care risk and to make sure they understand it. So we spend a lot of time developing this slide, which should give factual information in an easy to understand way. So we reading literature and relying on the results from focus group testing, we developed this slide, and it explains that as people get older, they're more likely to need help with activities of daily living. And if you do need help with 3 or more of such activities of daily living, you are called disabled. And these 6 activities include bathing, dressing, toileting, transferring, continence, and feeding. And we give an indication of how many men and women will become disabled at age 60, at age 55. And that's estimated from data. So underlying this is an analysis of 2 data sets, Charles and CLHLS, 2 Chinese follow-up household surveys, which we use to calibrate these numbers. We then inform individuals that there are 2 types of long-term care: informal care, which is long-term care provided by family or friends, and formal care, which is provided by some professional caring personnel. And that can be in a residential nursing home. And we give them an indication of the price. And this price differs depending on which group people have been allocated to. Whether it depends on the size of the city they live in. So we looked up these numbers, and we have basically 2 values: one for bigger cities, tier 1 cities like Shanghai and Beijing, and a lower value for smaller cities. And we explain to individuals that they can receive both types of care. And we say that the product will pay a monthly income. Then we ask individuals to imagine the following situation. We ask them to, we're telling them that they will have to choose how much long-term care income they should buy. And if they are male, we ask them to imagine that they are 60 now, that they are married. If they are married in real life, that they're about to retire, we give them, it's a bit like a vignette. So we give them the value of a home and a savings account, and so we kind of standardize this information that they should use in their decision making across individuals. But in our covariates, we collect in a lot of detail the actual situation, so we can see the impact of their true characteristics on the decision. But in the task, we ask them to pretend to make the choices as if this was the situation. Then we introduce.
Okay, we have 2 questions.
Ah, yes, please.
Okay. Yeah. Then the first question would be by Junao.
Yeah.
Oh, hi. So can you hear me?
Yes, very well.
Yes. Actually, I have 2 very brief questions. First is, you mentioned that this long-term care insurance product is not going to reimburse their expense, but provide a stable income.
Yes.
So, what's sort of the thought process of picking this type of product in the survey?
Yes.
And the second one is, actually, I'm not very familiar with the home release product. So, what would be the consequence of, like, after the owner pass away? So what happens to the housing equity in this product?
Okay, yes, these are very good questions. Thank you, Yunhao. So for the first question, why an income product? So we have very carefully read the research on long-term care in China, and we recognize that that individuals want to be looked after. So many individuals would prefer to be looked after in their own home, and if possible by a family member. But you can use such an income product to compensate, for example, your daughter-in-law or somebody else who gives up their other job to look after you. So this income product gives them the flexibility to pay for a formal carer or to compensate a family member. So we have used such a product design because it allows us to cover both informal and formal care. Regarding the second question, what happens when the individual and their spouse have passed away? So in the reverse mortgage case, it depends on how much they borrowed. So any loan they have will accumulate compound interest over the period while they are still alive and live in the home. And when they have passed away or permanently moved into a nursing home, the contract is settled, so the property is sold, and the sale proceeds are used to repay the loan. And if there is an addition, a remainder, it can go to the estate. If there is a shortfall, it is a loss to the lender. So the reverse mortgages usually have a guarantee, which is called no negative equity guarantee, which means that the individual or the family are not liable to insert extra capital if the house value is insufficient. It is only the home is used to settle the loan. In the home reversion case, the property is sold again, and the family or the estate receives the fraction of the sale price that the individual has retained, which they haven't sold. So say they use 30% of the home equity to buy long-term care insurance. Once 20 years later, when the house is sold, the daughter or the estate gets 70%, and 30% goes to the product provider. The other question is?
The other question is by George. George wants to read out his question.
Yes, no, I see the question. So George is right that both products are typically targeted to the retired population. Why is the focus here on the working age population? So if we go to our sample selection, it's 45 to 64, and we choose this because we think it's perhaps hard if they have already started retirement and make their financial decisions to rethink. So this is more like going into retirement. What would you do? So we want to see the potential demand of this cohort as when they retire. What would be their demand? So it is true we could include the older cohort, but then we would probably have to have 2 surveys, because you would have to have different questions for somebody who is already well into their retirement, say 10 years into retirement. You would have to have a lot of different questions, and so it is a bit simpler to keep it separate. And in our case, we choose this younger group to look at, as these are people that will retire in the next few years to 10 to 15 years. And we think this is a potential group to look at for our provider to develop products for, because all these things take time to implement.
Okay.
Okay. Okay. So I guess then I should move on. So we introduced 3 products. We introduced them separately. And for example, this is the product R, which combines long-term care, insurance, and reverse mortgage. And we give them first a short summary. We say you buy long-term care income product R by borrowing against your home. When you and your spouse need long-term care, you receive a regular monthly income. And then we say, now read the following details carefully, because you will be tested in a quiz. And then comes a long table. And this table was very short initially, but after we did the focus group testing, it was clear to us people really had a lot of questions. They wanted to know who offers this product. Okay, we said in this experiment, we say it's a state-owned bank, because we want to limit concerns about trust in the provider. And then we basically clarify a lot of questions that came up in the focus group testing and that people could have. So do they need to pay something at the beginning? No, there's no payment. Is your home used as a collateral? Yes. Can you continue to live in your home? Yes, you can. You have a guaranteed right to live there. Do you retain the full legal rights of your home? Yes. And so this goes on, is quite detailed. And then to make it really explicit to them, we give a numerical example. So this is the example of Ms. Wong, and they are 60 and 55 in 2019, and they have an adult daughter, and they live in their own apartment, which is worth 5 million, and they have some savings, and it's very similar to the vignette, the decision setting of the individual. But in this numerical example, we give them one possible choice. We say, okay, this couple, they choose to borrow 600,000 against their apartment, and that will then we spell out what the interest rate is, and we say what they would be receiving in case one of them becomes disabled or both disabled. And we say that they don't have to repay anything while at least one of them still lives in the home and they still fully own the apartment. And then at the bottom of the slide, we walk them through 3 scenarios, which is similar to what I've just explained to Yunhao. So in the first scenario, so we say what happens if Mr. Wong has passed away, but then Mrs. Wong becomes disabled and she receives an income and then moves into a nursing home. What happens then? So in one scenario, the provider sells the home, and there is a bit of money left over, and this goes to the daughter. And in scenario B, the house price growth was not very high, and the sale proceeds are lower than the loan amount, so the daughter receives nothing, but she also doesn't have to pay anything. And in the third scenario, the daughter uses and exercises an option in the contract, which we specified on the previous page, and she decides to repay the debt and keep the property. So this is something that we found in our previous research for China very important, to include an option that children can settle the debt and keep the property, that it doesn't automatically go to market, but it goes to it. They can settle the debt and keep it if they want to. So this is a numerical example. And then we say, okay, now assume again you have this amount in your savings account. You have a home. You are offered the long-term care income product from savings and the one where you can borrow. And now tell us, how much long-term care income would you like to buy? And there is 2 sliders, and they are asked to use the slider to indicate how much savings they want to use and how much they want to borrow against their home. And as they move the slider, the outcome table indicates what they've chosen. So it tells them at the moment it's set at 0, but if they move it to a positive amount, it will tell them, okay, this is how much income you would get from the different products. This is your remaining. This is what you've paid. This is what's still left on your savings account, and at the end, what happens is your housing bills, and so it gives them very detailed information about how the choices impact their financial situation. So the main task is using sliders to indicate how much of their wealth they want to allocate to long-term care insurance. And they do this 3 times, and then they summarize. We show them what they've chosen. We said we'll give them this table, and we say, okay, in task 1, you only had 1 product, and this is what you wanted to choose. In task 2, this is what you had 2 products, and you chose this. And in task 3, you had the other 2. And this is what you chose. And now tell us which of the scenarios was best for you and which was worst. And this is a bit interesting because the first scenario is just 1 product, and the other, and this product is also available in the other 2 scenarios. So if anyone who chooses A, if they prefer this, they could have also gotten there in B and C. They could just choose 0 for the other amounts. And we made clear on the previous page that if you don't want to buy this, you just set the slider at 0. So, but we will later see that some people preferred this simpler scenario with less choice. They didn't like to have two products to choose. Okay, so we have received the survey results, and we're analyzing them. And here's a snapshot of our analysis so far. So as I said before, the sample is 1,200. the median completion time, it took them 19 minutes. The average was 33 minutes. And they had this is self-rated product understanding. So we asked them on a scale from 1 to 5, where 1 is completely confusing and 5 is completely clear. How do you rate your understanding of the product? And most people, over 80%, they said for each of the products, they said, yeah, it was completely clear or mostly clear. And a very small number, just under 1 and 2%, said it was completely or mostly confusing. We also asked them how they rate the clarity of the survey, and they said it was mostly clear. So we were happy to see that all our effort in explaining this and working out how to explain it seemed to have worked. And this is, I guess, the main result that I want to emphasize today. So this chart shows you percentage of total wealth, housing and savings combined. So that it sums up savings account, housing wealth, and it shows you how much of this total wealth the individual has allocated to long-term care insurance. And in the first scenario, when only the long-term care income product from savings is available, on average, people choose to allocate 5.2% of their total wealth to long-term care insurance. But when we, in the middle column, when we also offer them the product where they can borrow against their home using a reverse mortgage, the LTCI product, they make use of this. They choose to allocate 10.9% of their total wealth from this housing wealth to buy long-term care insurance, and they slightly reduce the amount they use from the savings account. So in total, they allocate 15.7% to long-term care insurance. In the third scenario, where they can use savings or sell part of their home, they also make use of that on average and use 7.8% of the housing of their total wealth to buy long-term care insurance, and this adds up to 12.8. So looking at the increase of total wealth allocated to long-term care insurance demand from the first base case to the second scenario, it's an increase of 10.5, and it's significant in a one-sided t-test, and it's also, the increase is also significant in the third scenario. So we see a significant increase in the demand for long-term care insurance, and we see that individuals, when they can use housing wealth, they want to buy more long-term care insurance, which is in line with the previous literature, but it wasn't quantified before. And I want to mention that the decrease in savings is also significant because we have a large sample size. But yeah, so they use a little bit less of their savings. They use more housing wealth, and they use the liquid savings. They probably keep it for other reasons. So because this is kind of one main result, so I want to spend a bit more time here if there are questions.
Bruce actually has two, though the first one is, how is disability status assessed both in your survey and also in reality?
Yes. So in the programs that are piloted in China, long-term care insurance pilot programs, they're counting the number of ADL limitations, and we're using a similar, and we're using a definition that is based, say, at the moment, the individual has limitations with 3 or more activities of daily living, they become disabled. And sometimes in the literature, people use 2. And that is then a more generous insurance because you don't have to be as much disabled. You just need to have problems with 2 ADLs. And then but we use 3. So it's a bit more restrictive and therefore a less expensive insurance than it could be. So, and that is similar to what's currently being done in the existing programs in China.
I suppose my question is also about who does the assessing, and do the customers trust the assessment?
Yes. So this is a very that's a good question, because this came up in the focus groups and people had a lot of doubts about this. So I will give you the exact wording of how we say this, because it was cut from the slide where we describe the product. And I'm just finding it. So we, in this long product description, there is a question in this table, which is who will determine your health status? And the answer is you choose a doctor from a list of doctors appointed by the government. The doctor determines whether you or your spouse are non-disabled or disabled. Once you or your spouse are disabled, you will receive the entitled benefit for as long as you are alive. So we said it's a government list, and you can pick a doctor from that list.
Okay, thank you.
Mm-hmm. And it's also, there were similar questions around who assesses the house value. So there's how is the home value assessed? And the answer was the value of your home is assessed by an independent authorized appraiser. So in both cases, it's not done by the product provider, but someone external.
Right, okay. Thanks. And then the second question by Bruce was, does lack of trust of the LTCI provider reduce the value of these policies, even if they are state bank?
I think you've sort of answered that by saying you've got a model where people can trust it.
Yes. Yeah. So I have spent a lot of time, so I will go a bit faster. So we find that the more clear people rated their understanding of the product, the higher was the demand for this product. So we found that individuals preferred, 41% of individuals preferred the simpler scenario where just one product is available. And then we did a lot of regression analysis to see what explains the level of demand and also what explains the change in demand. And we confirm factors that have been found in previous literature and find that some other factors that make sense. So I'm just going to the summary of this. So we find the following factors leading for higher demand for these combined products. So people who have higher, and we split them between rational and behavioral factors. So we find that individuals who have both higher savings and higher debt are more interested in the product. People who have a daughter are less interested in buying this long-term care insurance, perhaps because they expect to rely on their daughter. We find, in terms of behavioral factors, I want to emphasize that so we have questions about, do you trust insurers? Do you trust the government? And people who have a higher trust in insurers in general have a significantly higher demand for these products. And importantly, we also find that it's very subjective product understanding is a main factor explaining demand. So with these covariates, we can identify who are the people who have that higher demand. And in summary, so I think I explained in much detail that we do a survey where we try to assess the potential demand for these combined products. When we look at the data, we find that when home equity is available to purchase long-term care insurance, we find a higher demand for long-term care insurance, and that individuals prefer the combination with the reverse mortgage product. They allocate more wealth to the long-term care insurance when they can use a reverse mortgage rather than home reversion. And with our research, we hope to do more modeling, feed this information back into a life cycle model, but also to inform the development of such products. So I want to leave some more time for questions, so I'll stop here.
Great. Thank you very much, Katja. That was amazing. George has another question.
Yes, so in your survey, is there anything about demand or preference for home ownership at older age, particularly if people are hit by severe long-term care shocks?
We have no, we don't have this. We have something about we know when they have bought the property. So we know how long their tenure in the property, which gives an indication of their emotional attachment. We know whether somebody of the family lives with them in the home. we know we have asked about the house price expectations. We don't have this question that you asked for, no.
So you may think that sort of if that happens, people may sort of have preference actually to sell their home and sort of to release equity in their home and sort of pay for nursing home and so on. So I'm just trying to figure out sort of what's driving. It seems to me when you show these this graph with demand for these two products increasing with having a home quite this one. So it seems to me that people have actually preference for staying at their home as long as possible, and that's sort of
which is I think what I mean, this is stated demand, but when you look at what people are doing in many countries, they don't move as much, right? They don't downsize, they don't sell, like they stay in their homes. So I think that yes, I agree with you. We're doing further research on this for Australia, and now we are including in this news that we were doing more of these control questions. So how long are you planning to stay in this property, for example? Would you use your house to pay for would you sell your house? So you're right, it would be good to have more of these controls, and certainly we'll do that in future research.
And you now has another question. Yeah.
Yes, hello.
Hi, so first one, looking at this chart, I'm also kind of sensing that because you provide the respondent with access to extra money, extra equity, and so it seems natural. Like we should expect them to have a higher demand. It's kind of mechanically because of that. And would you think of like other, I don't know, but it's maybe for future surveys, like offering them other options that they can access their home equity themselves, but not via the combined products. That would be some like another bar that I would like to see.
Something like and here's an option to sell your house right away, and that could be interesting. It's a different setting because then they would have to move, and it would tell you something about George's question, their preference for staying in the property and or their willingness to give up. Yeah, it's interesting. I agree.
And can you just explain a bit more of the slides where people prefer less choice than more choices?
Yes, of course. So earlier in the presentation, I explained that there are 3 different scenarios, and there's this scenario which we call LTCI, and it's the second column of the table, and it's where only the LTCI product where you use your savings is available. And then, for example, compared to this second scenario where the same product is available, and in addition the combined product with reverse mortgage is available, if we compare the average allocation of total wealth to long-term care insurance, to both products combined, we find that in the sorry, I'm confused. This is not about the wealth allocation. This is going back where they say which is the worst and which is the best. So 41% of people said that the first scenario was their best scenario. So they looked at their allocation. We showed them this table. We showed them this table here and said, okay, look again at your choices that you made. And you did A, B, and C. Which of the one was best for you? And looking back, 41% of people, most of the people said A. A was the best for me. This is my best choice that I made. And so, yeah. Hello?
Oh, it's just Yeah. It sounds like from econ perspective sounds irrational. So yeah, I just wonder if what would be like your maybe explanation or your thoughts on what happened.
Yes, so maybe they prefer less choice. They are overwhelmed by having to do 2 sliders and making choices across 2 products, or they got tired of the task itself. So they remembered, okay, this was the basic setting where I just had to do 1 task, but then I had to do all this reading to understand the second one, and I had to do all the reading to do the third one. So we can only speculate whether it is a true indication that they prefer a simpler scenario, or whether they it indicates that they got kind of exhausted or tired by the task and having to understand 2 products.
Yep, I think so. Yeah, that makes sense to me. Thank you.
Thank you.
Great. No one else in the chat said that they had a question.
Okay.
I think, well, it's also basically 1 p.m.
Yes.
So if you'd all agree, I think we can successfully finish this webinar. Thank you again, Katja. That was great. And I also thank you, everybody, for being here and for asking questions. And as said before, please email me any feedback that how we can improve this webinar, because this is, I guess we'll be doing this for a longer time now.
Thank you all for your questions and for your time. Bye-bye.
Bye.
Bye.